We are so lucky to have Taylor from LifeGoal Investments here, 12-year veteran of investing on Wall Street, working with the 1% of the 1%. He comes here once a month to give us the down and dirty of what's going on in the economy. Taylor, what's going on?
Holy smokes, we're getting curveball, fastball, changeup, all out of the economy lately, right?
Yeah, exactly, exactly. Well, why don't we start with the Fed's big move? They went 50.
Mhm.
And talk about, was that a surprise? Did you see? In hindsight, does it look like a mistake? Let's talk about that 50 first.
No, I wasn't surprised. I guess I was. I didn't think that they would go 50, but I thought they should have gone 50.
Hmm.
So that was kind of my take going into that meeting. And surprise, I guess, to me that they did go 50. And I don't think that it was a mistake. It is funny. Hindsight is absolutely 2020. So more recent data has shown the economy might be a little warmer than what we anticipated going into that. But nonetheless, they had just come off a massive revision downward in
Mhm.
the 1 year, essentially, job gains number revised down by over 800,000. And it did look like the right move at the time. And I still think that it probably is the right move.
Yeah, when you look at that, was that more of a makeup for not cutting in July, right? Do you think they should have gone a meeting earlier? Was that what it was, or no?
I think that that's what Powell said. He basically
Yeah,
said that in the meeting. He was like, yeah, had we known how bad our data is that we're taking in right now, we would have cut in July.
yeah.
Yeah, I think that for a while now, and by the way, I flipped the coin on this earlier this
Mm,
year. I thought that we may not see any rate cuts this year, but you
right.
did get some deterioration in the labor market, meaningful deterioration in the labor market. By the way, from a very rapid pace of hiring. So not to say that we're in like this ultra recession mode or anything like that, but the pace slowed, unemployment ticked up, and the trend was becoming what seemed to be clear, right? We've gotten some data sense that maybe it's not quite as clear.
Yeah. I mean, when you look at the data again, hindsight is always 2020. That jobs number, it's funny with this jobs number. It's like we all know it's dirty. It had a low response rate. The seasonal adjustments were bananas. I think even Austin Goolsbee, I think it was a Forbes article 2 days before it came out, said that the jobs number used to be the most important number he looked at, and he's
Yeah.
like, "Yeah, not anymore. We're not being very good with this number."
Yeah.
So it's interesting. But when I think about what happened to the cost of capital Friday, that's real.
Oh, huge, 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 huge move. Huge move in the back end of the curve. In the front of the
Yeah,
curve for that matter.
yeah, and it's been I mean, it was such a violent move on Friday. I was like, maybe Monday's going to give back because it just heading into the weekend or whatever. But it's continued to go up. In fact, the yield curve is now inverted again,
Yep.
right? The twos are above the 10.
I think there was real fear out there in the market that you had this kind of upward trajectory in unemployment, and then you had 1 month where it ticked down. And I think
Mhm.
the real fear was that the longer term trend was going to continue there. And so, therefore, as unemployment picks up, which it didn't do, but right, if unemployment did continue to pick up, that would show weakening economic developments, and yields generally come down when the market is weakening from an economic standpoint. And what happened was it wasn't a weakening number, it was a strengthening number to a degree and a
Yeah.
magnitude that no one foresaw coming.
Yeah, and then if you follow that up with this week, this Thursday, we get CPI.
Mhm,
Headline is, the experts are talking 2.3.
mhm.
We're getting really, really close to two,
Oh
right?
boy, are we ever? Yeah, yeah, and now everyone is an expert on peeling apart inflation and breaking down the fact that if you use more current numbers on housing, it would actually be in the ones and this and that. You've been talking about that for 2 years now,
Mhm.
but now everyone is literally parsing this data and saying, "No, we're good." Cut.
We're really
It
in the
is
ones,
interesting.
yeah.
It
Crazy.
is. I mean, uh, it's hard to look at historic data and say that a soft landing is probabilistic but right now you do have inflation continuing to weaken, and you do have unemployment tame, and it looks, at least if you take a snapshot right now, that a
Right.
soft landing is taking place.
Yeah.
Going forward in the future, yet to be determined. The numbers are not on the Fed's side to say that they're able to do so, but the data, case in point snapshot right now, it looks soft landing.
Yeah, no, I mean, I think that's why in their rate cutting cycle. Because I think the one thing that's still true today, as it was on Thursday before the jobs number, they're not anywhere close to the neutral rate. They know
Correct.
they're high.
Correct.
I do think there's going to be a battle brewing, and you saw a little bit of it in the announcement. Michelle Bowman, the lone dissenter,
Yep.
thinks that the neutral rate is closer to 4, where a lot of her, cohorts think it's like 3 to 3.5.
Yeah. It's
You
hard to get to where Michelle Bowman is at 4. I don't really understand her justification for saying that. Where inflation is right now in the twos somewhere, with Fed funds at 4.75, or however you clock that precisely, in that ballpark. That's a widespread. And it's tough to say that is neither contractionary nor expansionary. But I guess, in her defense, you look at the market and you go, doesn't seem to be contracting shit where the federal
know.
funds rate is right now.
Yeah, I mean, you could look at the numbers and go, man, they shouldn't have cut it all,
Yeah.
right? I mean, in hindsight, I mean, a 50 certainly seems, panicky, and all the Monday morning quarterbacks are coming out saying, the Fed looks silly for this and that. But again, I think they're going for the soft landing. That's what they're playing for at this point, right? They're trying to pull it off.
Well, broadly speaking, they've got the biggest inflationary proponent on their side, which is oil. Oil's been tumbling, right? Now it's caught a bit over the last week or so.
Hmm.
But broadly speaking, oil has been, I don't want to call it in free fall, but it is at, I don't know if it's a couple of year low at this point. And it's funny, it's coming amidst obviously huge pressure in the Middle East, which is the
Yeah,
oil hotbed. And I think what that shows is a little bit of, it could be made the argument, and this would be on the opposite side of things about economic weakening, but it could be made the argument that, listen, global demand is just not there. And I think that the big argument there is that China's just fallen off, and
yeah,
the Chinese demand is not there for oil, and they are a massive, massive importer. And a
absolutely.
lot of people will make the argument that that's not a reflection on the U.S. economy. The U.S. economy is a net exporter at this point. But I think it just shows broader, safety, broader protection, broader, I'm not using the right word there, but comfort in the fact that we are not as dependent on the Middle East for oil. And US
Yeah,
technology has massively changed that game.
yeah. I guess the one thing I sit here thinking about is, will the 10-year be higher or lower by the end of the week? Because we'll get CPI, we'll get PPI, we'll get another weekly unemployment claims. What do you think? I think I'll call the 10-year 4. Let's just call it 4 as we're talking. Do you think
Yeah.
that the 10-year is above 4 or below 4 by the end of the week?
Yeah, I think it probably is above 4. I think you're going to get some resistance. Those round numbers are very mentally exhausting, and to
Hmm.
get through it takes a lot, and then to get back down through it takes a lot. But on the other side of this, if you look at the charts, just technically speaking, nothing on fundamentals, this rally in yields is getting long in the tooth. And it's been rapid, right? I mean, if you look at mortgage
Oh,
rates essentially have been, which obviously are a function of yields, but this better than I do. Mortgage rates are up 50 basis points, 0.5% since
they're
the
up
Fed cut.
60 now. They're up
60.
60 now. Yeah, they're up 60. It's wild, right? The Fed cuts 50 and mortgage rates go up 6, go up 60
Wait,
basis points.
doesn't the Fed set mortgage rates though?
No, that's not what they do. Oh, you're just
unless
trying
you're
to judge me.
China, unless you're
Yeah,
China, who comes
yeah.
out and the People's Bank of China says, listen, we're going to cut mortgage rates, existing mortgage rates.
Oh yeah, existing. That was wild. We're going to cut rates on your existing
That
loans.
was that was one I had not seen before. I didn't look back to see if that was the first time that's ever been mentioned, but I don't know that
I've
that's ever been
never.
talked about.
No, I've never heard. That's always been one of those red lines you don't want to cross, right? Right.
Yes. Yep.
It's crazy. It's
Exactly.
crazy. Well, this is a lot of fun. Again, I think the Fed's playing for the soft landing. I think, man, I think we talked about this a year ago, and you thought the chances of both of us thought the chance of a soft landing were high single digits, low double digits, 10, 15%. Would you go higher than that today?
Yes, you have to. The
You
data
have
just
to, right?
forces you to say higher than that. I still, man, this is such a wackadoo environment between, just everything that history has told us when you is on its head. When you force a government, or I'm sorry, an economy to shut down, then you just pump it with the biggest steroid shot that anyone's
Mhm.
ever been shot full of, more than Barry Bonds in the early 2000s, right? That's what
Yeah.
happened. And then Now we're trying to figure out, like, how do we control it? Have we controlled it? Are we going to bring this thing down slowly? It's very hard to use history as an indicator right now.
Mhm.
And it's stupid to not at the same time. It's stupid to completely absolve yourself of everything that happened in the past, but it is different. And when we're trying to figure our way through it right now, I still fall on the side of, listen, when the Fed embarks on a schedule like this of rate hikes, it is very hard to bet against there being an inevitably a recession coming. And it doesn't mean it has to be nasty. It just
No,
means that it has to
absolutely.
be a reset of the business calendar.
Yeah. A
What's your
lot of fun.
what? Right back
Yeah.
at you. Hold on. Hold on. Right
Yeah.
back at you. What are you
Yeah.
thinking now?
I'm still actually I'm gonna go with kind of a left turn on you. I still think a rolling recession is what we're in. And we just never really experienced a multi-year rolling recession. And the best example I have is mortgage, right? The mortgage industry by some accounts is down 60%.
Yep.
But they're coming back, right? The refi numbers are up, although on small numbers, but up nonetheless. Purchase apps were up 7 weeks in a row. Now, this is all before this gigantic move in rates, so that could be over already. But
Right.
it just makes me feel that the hardest hit components of our economy are starting to come out, where maybe some of the travel, the restaurants are going in. So I'm going to stick with the rolling recession until I see otherwise.
Yeah. I like it. I like it.
Yeah. And where can people find you?
Find us at Life Goal Investments. We do 60-second daily clips on Instagram and on TikTok.
You're amazing. Thanks, buddy.
Thank you.